Here's a common mistake most people make. They think investing has to be complicated. They get caught up in the ups and downs of the market, worry about picking the perfect stocks, or try to time their moves just right. But what if that's all unnecessary? What if you could build wealth without all that stress and overthinking? In this video, I'll show you and Josh how to make investing super simple with just 4 index funds that take care of everything you need: stability, income, and growth. I'll break down each of these 4 funds, what makes them strong, and what kind of returns you can expect when you invest $9 a day. Then I'll show you how to build 2 easy portfolios using these funds, one focused on dividend income and the other on growth. In the end, I'll show you and Josh how one portfolio can turn $9 a day into a $1 million portfolio that pays around $3,000 a month in dividends. The other will turn that same $9 a day into a $2.8 million portfolio. Before we get to those portfolios, let's take a step back and talk about why index funds are such a great choice to make this happen. Investing can seem overwhelming, but index funds offer a simple, low-cost way to get started. The beauty of index funds lie in their ability to provide instant diversification. Instead of picking individual stocks, an index fund automatically gives you exposure to hundreds, sometimes thousands of companies, spreading the risk. Take an S&P 500 index fund, for example. Instead of choosing specific companies like Apple, Microsoft, or Amazon, the fund automatically includes all 500 companies in the S&P 500. That means you're not betting everything on one stock or one sector. So if one company struggles, the rest can still help the fund grow. Historically, the stock market has trended upwards over time, and index funds let you tap into that growth without needing to pick the right stock or worry about timing the market. They just track the market's performance and grow with it. Let's talk about fees. Actively managed funds, where professionals pick stocks for you, charge higher fees, around 1% of your investment. It might seem small, but over time it adds up. If you invest $10,000 in a fund with a 1% fee, that's $100 a year. Over decades, that could cost you tens of thousands of dollars in missed growth. Index funds charge much lower fees. For example, an S&P 500 fund might charge 0.05% or less. This means more of your money stays invested and growing over time, and those small savings add up big over the years. On top of that, index funds bring stability because they track broad markets. Instead of relying on a few individual stocks or sectors, they spread your risk across hundreds or even thousands of companies. Even in tough times, like during the 2008 financial crisis, markets have bounced back. For example, the S&P 500 rose 84% in just 2 years after 2009. That's why index funds are a reliable choice for long-term growth. There's also the tax angle. Because index funds rarely buy and sell their holdings, they trigger fewer taxable events than active funds. Less tax drag, more compounding. And historically, index funds outperform most actively managed funds over long time horizons precisely because of those lower costs. With lower fees, fewer taxable events, and broad market exposure, index funds offer both stability and tax efficiency. Now, let's look at how to pick the best index funds for your goals. When picking index funds, there are a few key things to focus on to make sure your portfolio is both diversified and cost-effective. First, check the expense ratio. Lower fees are always better because they let more of your money stay invested and grow over time. Next, consider the fund's performance, especially over long periods. Look for funds that have consistently followed their index and delivered strong returns compared to their benchmark. While past performance doesn't guarantee future results, it gives you a sense of how the fund holds up during different market conditions. If you're looking for income, pay attention to the dividend yield and dividend growth. Higher yields are better for those wanting a steady income. But if growth is your goal, focus on funds that have stronger potential for price appreciation. Lastly, make sure the fund is well diversified. A good index fund should spread your investments across a broad market, whether it's a total US stock market fund, an international fund, or one focused on a specific sector. By balancing these factors, cost, performance, yield, and diversification, you can choose index funds that align with your long-term financial goals. Alright, that's the foundation. Now let's talk about the actual funds, and I'll start with the most well-known one, the Vanguard 500 Index Fund Investor Shares with the ticker symbol VFINX. VFINX is often considered the backbone of a well-diversified portfolio, especially if you're focusing on the US stock market. It tracks the S&P 500 index, which includes nearly 500 of the largest and most influential companies in the US. What makes VFINX so appealing is its diversification. Instead of betting on one company or sector, VFINX gives you exposure to a wide range of industries, reducing risk. VFINX has delivered strong returns consistently, making it a great option for long-term investors. In the past year, it returned 16.18%, and over the last 3 years, it's delivered 20.94%. The 5-year return is 14.83%. Historically, VFINX has posted double-digit returns over the long term, consistently outpacing many actively managed funds due to its low fees and broad market exposure. The fund offers a dividend yield of 1.02%. While this isn't the highest yield, the real strength of VFINX lies in its price growth. The dividend income is paid quarterly, and the dividend growth rate over the past 5 years has been 5.25%. Meanwhile, the fund's annual share price appreciation is around 13.49% over the past decade. One of the biggest advantages of VFINX is its expense ratio, just 0.14%. This is much lower than the 1% or more that many actively managed funds charge. This low cost means that a larger portion of your investment stays invested, helping to grow your wealth over time. Over decades, this small fee difference can translate into tens of thousands of dollars saved, compounding in your favor. Like any investment, VFINX can experience some volatility. Its standard deviation is around 11.65% annually, meaning there will be ups and downs. But because VFINX tracks the broad US market, it tends to be less volatile than investing in specific sectors or individual stocks. It's well suited for long-term investors who can weather short-term fluctuations in exchange for long-term growth. Let's look at how this could play out for Josh if he invests $9 into this index fund. By the end of year 1, Josh would have invested $3,285. This sets the stage for future growth. By year 10, his portfolio will be valued at $64,000, with dividends projected to reach $250. By year 20, his portfolio will be valued at $295,000, with annual dividends of $500. After that, the compounding effect becomes more noticeable, and by year 30, Josh's portfolio is projected to be valued at $1.1 million, with annual dividends to reach $1,000. Now, VFINX is powerful, but it only holds American companies. That means you're missing out on a huge chunk of the global market. That's where our second fund comes in, the Fidelity Global X US Index Fund, ticker symbol FSGGX. In the end, I'll show you and Josh how combining all 4 index funds into a single portfolio with a $9 daily investment can be tailored into either dividend income or growth. The income version will turn into a $1 million portfolio paying around $3,000 a month in dividends, while the growth version will reach nearly $3 million. But first, let's take a look at the second fund. Here's something most investors don't realize. The United States makes up roughly 60% of the entire global stock market, which means if you're only buying US funds, you're ignoring 40% of the world's publicly traded value. All of Europe, all of Asia, Latin America, the Middle East, emerging economies growing at rates the US can't match anymore. FSGGX gives you all of that. It tracks the MSCI ACWI ex-USA index, over 2,000 companies across developed and emerging markets outside the United States. Taiwan Semiconductor, Tencent, Samsung, ASML, AstraZeneca, Alibaba, Nestle. Companies from the UK, Germany, Japan, South Korea, Brazil, India, and dozens more. The key reason to own international stocks alongside US stocks: they don't always move together. When the US market is flat or going sideways, international markets can be in the middle of a strong run, and vice versa. FSGGX lets you capture that divergence without doing anything different. FSGGX has posted strong returns since it began, with a 1-year return of 35.21%, a 3-year return of 16.33%, and an average annual return of 9.15% over the past 5 years. It outperformed many US-focused funds thanks to the different growth cycles in international markets. It offers a dividend yield of 2.48%, which is higher than many US-focused funds. International companies, especially in Europe and Asia, tend to pay higher dividends to attract investors. The dividend income is paid out annually, providing a steady stream of income to investors. The fund's dividend growth rate is 15.15%, indicating strong growth in dividend payments. One of the standout features of FSGGX is its ultra-low expense ratio of just 0.055%. For a fund that provides broad international exposure, this is incredibly cost-effective. Now let's see how Josh's $9 a day investment would play out in FSGGX. At the start of the year, it's just the initial investment. By year 10, his portfolio balance will be $56,000, and his dividend income will grow to about $2,000. By year 20, the portfolio will grow to $294,000, with dividends reaching around $25,000. By year 30, the portfolio is projected to be around $2.4 million, and dividends will hit $392,000. This progression highlights the power of reinvested dividends and the impact of steady long-term growth. Next, let's look at the third index fund on the list, the Schwab Target 2045 Index Fund with a ticker symbol SWYHX. This one, you set it up once and the fund does literally everything else. SWYHX is a target date fund. The target is 2045. Right now, it's allocated roughly 90% stocks and 10% bonds, aggressive growth while you still have time. But as the years pass and 2045 gets closer, the fund automatically shifts its own allocation. It sells out of stocks gradually and moves into bonds and more conservative holdings on its own. You don't rebalance manually. You don't adjust your stock-to-bond ratio as you age. You don't do anything. The fund handles it. And it's not just one or two holdings inside. You've got a basket of Schwab ETFs covering US large-cap stocks, international equities, aggregate bonds, emerging markets, small cap, and real estate. A fully diversified retirement portfolio. One fund, one ticker, one decision. SWYHX has shown impressive returns, which is why it's a top pick for long-term investors. Over the past year, it returned 17.66%. Over the last 3 years, it returned 16.42% on average, and its 5-year return stands at 9.19%. The fund is designed for younger investors with decades to go before retirement, so it prioritizes capital appreciation during the early years. One of the best things about SWYHX is its low expense ratio, just 0.08%. This low cost means more of your money stays invested and compounding, boosting your returns over the long run. The fund offers a dividend yield of around 2.01% with a dividend growth rate of 12.38%. It also has an annual share price appreciation of 8.48%, which reflects its bond-heavy allocation. The dividends from both stocks and bonds are reinvested to further grow the fund's value, and in the early years, the focus is on using those dividends for capital appreciation rather than immediate income. As a target date fund, SWYHX has a higher degree of risk in the earlier years due to its high allocation to equities. This means that the fund can experience higher volatility in the short term, but over time, as the fund shifts toward fixed income investments, it becomes more stable. Now, based on these metrics, let's project how Josh's $9 per day investment in this fund will play out. By the end of year 1, Josh will have invested $3,285, setting the foundation for future growth. By year 10, his portfolio will be valued at $55,000, with annual dividends projected to reach $1,000. By year 20, his portfolio will grow to $229,000, with annual dividends of $8,000. By year 30, Josh's portfolio will be valued at $886,000, with dividends projected to reach $47,000. For the investor who wants simplicity above everything else, SWYHX might be the single best fund on this list. But if what you want is the absolute maximum growth possible and you can handle some turbulence, Fund 4 is what you've been waiting for. The Vanguard Information Technology Index Fund Admiral Shares, VITAX. This is the aggressive one. The other 3 funds are diversified and balanced. VITAX is concentrated, sector-specific, and purely about growth. It holds over 300 technology companies, NVIDIA at 18%, Apple at 14%, Microsoft at 11%, then Broadcom, AMD, Palantir, Cisco, IBM, Micron. Nearly 100% of its holdings are tech stocks: cloud computing, artificial intelligence, semiconductors, cybersecurity, enterprise software, the industries that are reshaping every other industry. The technology sector has been the best performing sector of the last decade, not by a little, by a lot. And the argument that it's done running is hard to make when AI adoption is still in early innings and global digitization is still accelerating. Here's the honest trade-off though. VITAX is volatile. Its standard deviation is 18. That means it moves harder in both directions than the other funds on this list. During strong market years, VITAX can deliver exceptional returns, but it may experience significant drops during market corrections. You need a long time horizon and the stomach to not sell when it's ugly. But if you have both of those, the compounding is in another league. VITAX has delivered impressive returns for long-term investors. Over the past 5 years, the fund has provided an average annual return of 17.09%, benefiting from the strong performance of technology companies in the U.S. market. The 1-year return is 21.81%, highlighting continued demand for technology products even amid market volatility. Historically, the technology sector has outperformed many other sectors, making VITAX a solid option for investors looking to capture high growth within a thriving industry. VITAX offers a low dividend yield of 0.41% with a dividend growth rate of 0.87%, as it primarily focuses on capital appreciation rather than generating income through dividends. Most technology companies reinvest their profits into business growth rather than paying high dividends. So while this might not be the best fit for income-seeking investors, it's an excellent option for those looking for growth in a thriving sector. The fund distributes dividends quarterly, though they tend to be modest compared to other sectors. Now, based on these metrics, let's see what happens when Josh invests $9 per day in this fund. By the end of year 1, Josh will have invested $3,285, setting the foundation for growth. By year 10, his portfolio will be valued at $95,000. By year 20, his portfolio will grow to around $787,000. And by year 30, Josh's portfolio will be valued at nearly $5.8 million. The dividends are minimal, about $20 a year. But again, that's not the point. The share price appreciation is the return. You're sitting on almost a $6 million asset built from $9 a day and 30 years of doing nothing. So, 4 funds, 4 very different profiles. Now, here's where it gets interesting. Because on their own, each fund has its own strengths and weaknesses, but when you combine them into a portfolio, you can dial the strategy toward exactly what you're after. Let's build 2 portfolios using these same 4 funds. The first one is for people who want their money to generate income, a cash flow they can live off of, ideally when they retire or maybe even before. The second is for people who want to build the largest possible portfolio value and aren't worried about income yet. Depending on where you are in life or what you're aiming for, these funds can be weighted in various ways to serve your objectives. For the dividend-focused portfolio, the goal here is to create a steady stream of income while still allowing for growth. This strategy works great for those who can plan to rely on their investments to support them in retirement. For this portfolio, we allocate 60% to FSGGX, 20% to SWYHX, and 10% each to VFINX and VITAX. The portfolio will have a total dividend yield of 2.03%, with a dividend growth rate of 12.18% annually. The portfolio's expected annual share price appreciation is 9.75%. Now let's run the numbers on this portfolio, assuming Josh invests $9 a day. By year 10, his portfolio will be valued at $58,000, with annual dividends of $1,750, about $145 per month. By year 20, his portfolio will grow to $234,000, with dividends projected to rise to $8,000 annually. And by the 30th year, your portfolio would be worth about $943,000. In that final year, this portfolio would be paying you approximately $34,000 annually, which is almost $3,000 per month. Now, what if income doesn't matter to you right now and you just want the biggest number possible? That's the second portfolio, the growth portfolio. This one is simple. Load up on the highest appreciation fund and use the others for stability. For this portfolio, we allocate 70% to VITAX, which has a 0.41% dividend yield, but a remarkable 22% annual share price appreciation. The remaining 30% is split between FSGGX, VFINX, and SWYHX, which provide more modest dividends but are key for stability and diversification. For the growth-focused portfolio, the total dividend yield is 0.84%, with a dividend growth rate of 3.89% annually. The expected annual share price appreciation is 18.35%. Now, let's look at the projected performance if Josh invests $9 per day in this growth-focused portfolio. By the 10-year mark, his portfolio would grow to around $80,000. Keep at it, and by year 20, it will reach approximately $514,000. By the time Josh hits 30 years, his portfolio could grow to around $2.85 million. Now, the dividend income from this strategy? By year 30, Josh would be receiving about $220 annually, roughly $18 per month. The trade-off here is clear. You're building massive wealth over the long term, with dividends gradually increasing as the portfolio grows. It's a totally different approach, but the logic behind it is just as solid. The real question now is, which approach fits your goals? Want to know how to turn the same $25 a week into a $1.6 million portfolio that pays over $6,000 in dividends every month? Click the video on screen to find out how.